First REIT invests in healthcare properties, 13 in Indonesia, 3 in Singapore, 1 in South Korea. And every year when I review the annual report, new properties seem to have been added. They also announced the acquisition of the so-called Kupang properties late last year. This is a $70 million acquisition, once again a discount to the higher of two valuations. The particular interest about this particular property is that it comes attached to a mall with a cinema. The building is also relatively new. It seems to have commenced operations only about a year earlier. And they also announced a very interesting asset swap in Surabaya, where they in essence swapped an old building for a new one, which is still under construction. The old Surabaya hospital has 160 beds. There are 2 plots of land, which is why you're seeing 2 amounts on this graphic. They total about $35 million. So even as they earned that $35 million from the sale of these 2 plots, they spent $90 million in order to buy the new hospital when it's ready in 2019, currently under construction. You can see there too that it'll have many more beds than before. A couple of interesting points from this one, and by the way, you can get full details of that transaction, not so much in the annual report, but if you go back to the October 21st disclosure, 35-page document spells it all out. In essence, what's interesting is that it's a 12-story building, this new one, and it'll be launched at a time that universal healthcare in Indonesia will have been made available to all Indonesians. At least that's the plan in the year 2019, so just in time for that. Also of note is the fact that the manager of First REIT collects a fee both on the acquisitions and divestments. So rather than simply kind of do the asset enhancement of the Surabaya hospital, they've actually sold it back to the sponsor, and the manager in that case collects a 0.5% fee, and then they're buying back the revamped property in Surabaya once it's ready in 2019, for which they'll collect a 1% fee. So not just a straight renovation, it is in fact a sale and then a purchase. So that's where the additional fees for the manager will come in. Back to page 4, where that chart earlier on the assets came from, because there are a couple of other charts that are quite interesting to look at. Gross revenue is one, and you can see that that trend is just up, up and away. But again, there are a few more details to take note from this revenue chart. The first is part of the reason why you are constantly seeing such an increase in the revenue is because they keep adding buildings. The Siloam Sriwijaya building, which they bought December 2 years ago, has now made a full year contribution, part of the reason for the increase. The Kupang properties, which I just mentioned, they have also started to contribute, although no details as to exactly how much has come in. And they have also registered, in their words, higher contributions from existing properties in Indonesia and Singapore. And I found that particularly interesting because they also have a property in Korea. Didn't that contribute? Well, what you can see on page 91 is that the Korean property makes up a very small part of this portfolio. It's worth around $8 million. And so you can see that in the broader context, it is a very small part. But what was interesting is that the Sarang Hospital in Korea should have registered gross revenue of $885,000, but they took an impairment charge against that revenue of $246,000, so more than a quarter of the revenue. And so, of course, that raises the very interesting question at the annual general meeting as to why the tenant, the lessee of that hospital that First REIT owns in South Korea, has had an impairment charge. Is the operator not paying their rent as they should? And it's a very substantial amount considering what First REIT earns. Certainly in terms of proportions, the impairment charge makes up quite a substantial chunk of that. So perhaps a question for the annual general meeting. And by the way, the first quarter earnings are in fact out just before the AGM. So much more to talk about there. Back to some of these charts, and again, there are some more stories that can be told just by looking at the charts on page 4 and reading it reading these in conjunction with the rest of the annual report. Here are some details. Again, net property income looks great, the way that that's up and away. But the net property income of $99.3 million, which you can see here on the right side of this graphic, is not what's coming shareholders' way. Because from that net property income, you have to subtract almost $10 million worth of management fees. See page 40 to read the justification as to why they earned $10 million. You also have to subtract $16.5 million in finance fees because the debts keep going up because they have to keep loaning money in order to buy those assets. You have to subtract $2.5 million in other expenses, which is up from $1.8 million last time. And you also have to subtract $28.5 million in tax, which was also much more than the $22 million last time around last year. The fair value gains this year were also much less than they were in previous years. Instead of 47 in 2014, they booked fair value gains of only 24 million, so half that amount this time around. So as a result, the total return for the year was actually down from $90.5 million to $67.8 million in 2015. Now, it doesn't end there either, because some of these changes that you saw are accounting related changes. So when you go back to page 47 and 48, you can see some of these things being added back in order to derive the amount available for distribution. And the good news is that that amount is still shy of that $99 million figure that we see on the charts on page 4, but at least it's up from the $72 million last year to $76 million, and part of that is the reversal of a charge in fair value of investment properties net of deferred tax. So it pays to be an accountant to read some of these things, and of course make sure that once again you take in all of the details from the annual report. Don't just stop at the pretty looking charts. The distribution per unit is up 8.3 cents per unit, and incidentally you can find out further details about the dilutive effect that the dividend reinvestment plan has. A dividend reinvestment plan is something a lot of companies have because they, rather than paying out the cash to shareholders, they would much rather keep the cash in the company in exchange for new units. In that way, 8.3 million new units were issued. So you're getting 8.3 cents per unit in cash, 8.3 million units issued through the dividend reinvestment plan. Curiously, though, what you'll also see on page 81 is that actually 30 million new units are now issued from this REIT compared to 2014. So a very substantial dilution. How? Why? When the dividend reinvestment plan only accounts for 8.3 million of those, the answer is that half of the 30 million additional units listed since 2014 were issued to the manager for the acquisitions that they made. Now on to the debt levels. Gearing is up slightly, but not much, 34%, still well within the range, the 45% ceiling that the regulations have determined. So in their words, they still have a lot of room to borrow more in order to buy more assets. And where are they going to come from? Well, the sponsor has another 8 properties available. Currently, First REIT owns 12 out of the 20 that the sponsor has, according to the annual report. A further 44 are in the pipeline. Incidentally, the debt is largely at fixed interest rates, although that fixed rate tends to be higher than the floating rates that they're currently paying. According to page 86, you can see that the range of floating interest rates per annum was from 3 to 3.2%, up from the 2.4 to 3% last year. So being a floating rate, as rates rise, you would expect that to rise, 3 to 3.2% now, whereas the fixed interest rate on page 86, you can read it, hovers between 3.39 and 3.75%. So fixed means no negative surprises as interest rates rise, but they do pay a higher interest rate than the floating rates. One question for the AGM, by the way, might be when those 44 projects that the sponsor has in the pipeline will be completed and when they'll become available for First REIT to buy. A quick look at page 6, where we have the combined chairman and chief executive statements. The chairman, Albert Chok, there on the left, and chief executive, Dr. Ronnie Tan, on the right. And again, some very interesting commentary. Usually when I read the chairman or the CEO statement, I'm looking for forward-looking commentary. What's the outlook? What's the future hold? And that's where I found this comment particularly interesting. Apart from Indonesia, where obviously the bulk of their assets are, First REIT will continue to explore acquisition opportunities in other parts of Asia to diversify our asset base. A question for the AGM: which other parts of Asia? Of course. And one last point to look at, and that is on page 10 of First REIT's annual report, where we see this photograph of the directors. Now, the two gentlemen on the far left of this photo are standing, Mr. Goh Tiem Lock and the chairman, Albert Chok. What's interesting is that both of them were appointed in May 2006, and of course, that's almost 10 years ago. Now, in order for a director in Singapore to be determined to be independent, they have had to be on the board for less than 9 years. And seeing that both of them have now been there for almost 10 years, of course, that raises the question, will the board deem them to still be independent? We usually see annual reports carry a fairly standard paragraph about how the board has assessed their contribution and deems them to be independent. Perhaps that's what we're going to read. But perhaps also Chairman Albert Chok will choose a different route in terms of his declaration of his independence in view of the fact that he is one of the vice governors of the Board of Governors of the Malaysian Institute of Corporate Governance. You can meet all of these directors at the annual general meeting Tuesday the 19th of April at 9 a.m. at the Mandarin Orchard.